It's been so long since we've done a podcast that software is constantly updating. And so all the controls are different. Even the logos and everything are different. I'm pretty sure the company we used to record this has changed hands even.
It does look, the logo looks different.
I know, like a lot can change in 6 months.
Did it make you update like 3 times before you could get in?
Yeah, well, thankfully it didn't do that. But yes, it's there are a bunch of new widgets and stuff. So thankfully we don't need any of that stuff. But it just goes to show how long it's been since we've cut one of these, which is 6 months.
6 months.
Yeah, really. And last time we did one of these, Ryan, it was just you, and we were talking about the outlook for the year. I think if we wait another 6 months, we can go back and look at what our takes, whether they were good or not. I suspect we were undershooting on the performance of the stock market when we started the year.
Oh, 100%. Or we're already there. We're already where we said 6 months into the year.
Yeah, we got a whole year's worth of returns in 6 months.
Yeah.
Yeah.
Well, that's like LPL's like, yeah, we're super bullish. Our target's like 1% off of where we are right now.
Right. They always do that.
There is some of that. Okay. Well, so we haven't done a podcast in 6 months, which means the last time we were talking about this, we were talking about New Year's resolutions. How are your New Year's resolutions going?
I don't even remember. 6 months was so long ago. I don't think I ever remember what my New Year's resolutions was. Maybe it was my knees, which I am working on. If that's the case, I honestly don't remember what it was. I think it was had to be around like health and knees, and like really focusing in. So I will say I am still on that binge. So I'm happy with that. If that was my resolution,
our New Year's resolution for next year can be consistency.
Yeah.
For Christ's sake, I don't know what mine was. Mine had to do some of the reading books, and I can tell you I've gotten through a few more books this year already than I did last year. So I'm working to that end, but I don't remember what my other ones were. Eric, did you have any New Year's resolutions?
I've had like the same one for probably 5 years, so I haven't really achieved it. And
which is what?
It's really low bar. I'm so sick of my wife telling me like to close the cabinets. So I'm like, I really need to close the cabinets when I'm done doing it. And then
are you like, what was the movie with Bruce Willis, like I See Dead People?
Sixth Sense?
Sixth Sense. Yeah, where he's in the kitchen and all the cabinets are open. Is that you?
She calls me the poltergeist.
Yeah. Okay. Yeah, that is you.
But I still, they're always open all the time. It's like, why close it? I'm just going to open it again. But I'm really trying to,
close the cabinet.
I'm sorry.
windows.
That's going to pertain to a lot of things, including your car.
Yeah, that's true.
Yeah, you got to close it. You got to put down the toilet seat, right? You got to close the cabinets in the.
But this year, I've still got 6 months, so we'll see.
Yeah, there's time left to do it. Well, I think it's interesting. So we're gonna go. If you don't listen to this often, we often cover. No. So it's been so long. I need to do the intro. This is where we'll stop and go ahead and do the intro. You guys ready to get started on this?
Yeah, definitely.
Yeah,
let's get rolling. Welcome back to the Casual Friday Financial Insights podcast. My name is Brian Ullman. I'm a financial advisor here at Ford Financial Group. I'm joined by Ryan Louie, who is always on this podcast with me as well, also a financial advisor at CFP at FFG, and Eric Simonians, who has been on this podcast a few times before. Maybe we can make it more of a regular deal. He is also a financial advisor in CFP here at Ford Financial Group. And so today we are tackling LPL's mid-year outlook. So the last one of the kind of what we were referencing in the intro is the last one of these that we cut. We were reviewing the 2026 outlook from LPL's research department. And this time now we have a mid-year outlook that we'll be reviewing. And frankly, guys, I think we should get Schwab's and Fidelity's and any others and just spend months reviewing mid-year and criticizing mid-year outlooks and critiquing how people can't tell the future. We could even retitle the podcast that way.
That's why I have the dartboard.
There you go. That's how you get your outlooks.
Yeah. It's pretty reliable.
It has like I think there are plenty on there.
What's that?
It has the S&P, the numbers of the S&P 500, so you could throw it and see what the year is going to end at.
Exactly.
I'll be honest. I think there's a handful of research departments that use a dartboard for their 2026 and their mid-year outlooks. So we're going through LPLs. We're going to cover. We're not going to get too. There are lots of things that get covered in here. They even talked about things like cryptocurrencies and gold and stuff like that. We're not going to get into those. We're going to kind of stay at the higher level topics so we don't go forever and ever. In this case, we are beginning with the economy, and then we'll talk about stocks, bonds, and then just kind of some themes. We talk about, there are a lot of things going on here. AI, what's going on in the Middle East, midterm elections, interest rates, that kind of stuff. So we'll kind of get into this, and we'll start with LPL's view, and then we'll kind of give the takes that we have for all of this. Anything else before I dig in, fellas?
No.
Pretty straightforward. Okay, let's get rolling. We don't need a talk from the CIO, but we are going to start with the economy. Let me get the midterm elections here. Let's go economy. Okay. So here's what LPL's view is on the economy. They think that growth is going to moderate, but stay positive in the second half of 2026, likely under 2%. Recession is not in the base case. They think business investment is offsetting a housing sector still hurt by high rates. Much of it's related to AI related CapEx, etc. They're expecting inflation to cool to 2.9%, but only if geopolitical tensions meaningfully ease, which
that's
is
my favorite part.
That's a big if.
Inflation will cool if the thing that's causing it goes away.
Yeah, right. I know it stays high until it's not high. Unemployment drifts up to 4.6%, but that's framed as part of a low hire, low fire labor market, not a weakening one. Elevated household net worth relative to income is doing a lot of the heavy lifting here to keep consumers spending. What do you think? Less than 2% growth in the second half of 2026? It seems reasonable here.
Fair. Like, we ran pretty hot in terms of growth, and so therefore, things can cool. We've seen this before. I think things can cool down, but still stay good or strong enough that we don't need to worry.
Yeah, I think like the low hire, low fire take, I think on this is interesting. I don't know if the unemployment rate is the same kind of signal right now that it's been. 4.6% unemployment is still historically low. I don't know if that's much of a call. I think what's crazy is the 2.9% inflation call. I mean, that's their base case. I mean, assuming some things happen, that seems like a best case dressed up as a base case here. 2.9% inflation.
It's really more of a call on energy prices than inflation.
That's the driver, right? Oil prices, but we're not asking for oil prices to come down anymore. Like, this is, a couple months ago we were talking about, well, for inflation to come down, we really need to get oil prices down. We're there. We're just last week we were at prices below like pre-war levels, right? So like the oil has come down. Now it's got to stay down for a long period of time. But like, we're not asking for it to do something that that might not happen.
Yeah. Well, this thing was written probably when the ceasefire was in place, right? And a lot can change in just 2 or 3 weeks, which is like literally, we're closing the Strait of Hormuz again, and we're back at it. And to think that we can negotiate peace in the Middle East in 2 months is like.
Well, CPI comes out tomorrow, probably will reflect the lower prices you're talking about, Ryan. Probably, but then we have another month or a month and a half, so it's a moving target. But I think, 2.9 is kind of where we were at. What, like a month and a half ago?
Yeah, we were in the fours when we had
4.2.
Yeah. So the idea that we would even get back down to threes, much less. I don't know. I think this is fanciful, being honest with you. Like that level of inflation in the second half of the year. I mean, if we got down to a 2 something inflation rate, and the Fed then in turn is either keeping rates steady or cutting them, that's a pretty big about face from where we are, quite literally here at the middle of the year. I don't think that's a realistic take.
But this is what's going to drive the Fed. This is what's going to drive bonds.
Totally.
Right? And so we're very, very focused on this all over again. And we keep talking. I mean, Brian and I have talked about this forever. It was like we talk so much about the Fed Fed for years. It seems like we were talking about it. And then it felt like, oh, maybe we might get away from having to talk about what the Fed's doing so much. And now we're, fully focused on it all over again.
Yeah. Well, I would say in a nutshell here, LPL's take on the economy is that their whole inflation forecast has an asterisk on it, and that's that the Strait of Hormuz is open. And today, as we record this, halfway through July, it's not, or has been reclosed. So I think this is, I don't know if it's much of a take. Let's get into stocks. Okay. So LPL's take on the stock market is they think the bull market's going to continue in its fourth year of expansion. Historically strong year for stocks thus far. Pretty obvious here. Their year-end S&P target is somewhere between 76.50 and 77.50, which is what, 200 points on the S&P.
Like a point and a half.
Yeah, so 1.5% to like 3%.
Yeah,
from where we are today.
That's built on a 22 times multiple on forward earnings per share for the S&P. So multiple expansion to get us there, because right now we're at 20 times forward earnings, I think.
I think part of this is that their bet is volatility comes, markets can drop at some point in the second half, and that becomes your buying opportunity. If you're just writing things out, you're looking at a very small gain from where.
So they're not as bullish as it sounds. Really?
No,
definitely not.
No. Here's something that's interesting. So LPL recommends that a modest U.S. equity overweight, but downgraded the technology sector from overweight to neutral because of crowded positioning, despite the 50% earnings growth. So they're saying overweight U.S. So great, but downgrade the technology sector. I think what they're missing here is that if you're overweight U.S., or even if you're just doing the S&P 500, 2/3 of the S&P weightings is coming from the technology sector. So how do you underweight tech and overweight US in the same?
I mean, you really actively have to do it, because again, like you said, you have to get away from the index, and so then therefore you're really tilting it towards value, mid cap, small cap, those types of things.
Yep, they say consumer discretionary is a high conviction underweight, and energy and industrials are preferred overweights. So I get that. That's how you do it. Then you go value, right?
Yeah.
Eric, what do you think?
Yeah, I mean, it sounds kind of what you're saying. They're expecting volatility, underweight tech, which is where all the growth is coming from. But it sounds like they like the earnings is strong, which limits downside. So, but the valuations are, I think, maybe a little lofty.
Sure.
So there's going to be maybe some opportunities to shift things around. But it sounds to me like they're not as, like I said before, they're not as bullish as the headline in the report sounds.
Yeah.
Well, their bullish case is almost, we'll have some volatility and the market will drop, and then that's your chance to buy the dip. And that's always hard, because where do you get the money? Where do you get the money for that? Most clients aren't, they're not going to shift a ton of money from bonds to stocks on a dip, because that just increases their risk, which that usually is not their appetite.
Yeah.
Most clients aren't sitting on necessarily a pile of cash to then just dump into the stock market waiting for a dip. So it's not like the easiest opportunity that's going to be available to clients just to seek.
Yeah, I feel like this was their take last year in the mid-year outlook, Ryan, when we were doing this. It was, they were bullish on the second half, and then they gave some S&P targets, and you do the quick math and you're like, oh, they're looking at 2 to 3% in the second half of the year. That's like not much, like Eric's saying, not much of a bullish kind of base case there. It seems like a pretty conservative outlook. The AI stuff feels like we're playing musical chairs right now, where we're all just staying in it and moving slowly, waiting for the needle to come off the record so everybody can just kind of hit the exit all at once. I don't know.
Yeah, but we had that interesting January and February where, the the tech stocks definitely weren't performing with the rest of the markets. They were down for the first couple months, right? And we all thought, oh, here it comes. Like the S&P can't hold up if the Mag 7, is doing poorly. And sure enough, it kept rolling along because everything else was performing. That's our best case scenario, is the hope for maybe if they do a cool down or just move sideways for quite a while.
Right. The spending's going somewhere, right? I mean, like one company's AI revenue is another AI expense for the other company, right?
Yep.
Oh, 100%. Yeah. I think you've seen some of these like industrials and some of these other companies that are the beneficiaries of their CapEx spending, right? Is going to other people's pockets.
Yeah. I don't know. I think their take on this reflects how messy it all is right now and how opaque like any projections are. I mean, I don't want to say more than usual, but like really, like everybody kind of knows where we sit, but nobody knows where we're going, including LPL research here, right? Because it can go either way. Well, I'll just get to with that in mind. I'll get to the bond. This is sector stuff. Getting the bonds. Okay. LPL is saying that new Fed chair Kevin Warsh is going to stay on an extended pause, at most one cut likely in December. Do either of you think we're getting a cut this year?
No.
What are we talking about here, right? 10-year Treasury yield forecast 4 to 4.5%, range bound for the rest of the year. I think that's probably a pretty easy call, don't you?
It hasn't changed much.
I mean, it hasn't changed much in a while. I don't even know what's the 10-year here at today.
Probably
I know
5 something.
4.627.
Oh. Yeah, I was gonna say that the ag's interest rate's like 4.55. So
yeah, but it was up here a little bit today, just on the reignition of everything going on in the Middle East.
I actually think that chart that you have at the bottom of the screen is actually the interesting one. It kind of shows just where people's expectation or the market's expectation has been.
Sure.
How many cuts we're going to have. And then, it's hovering around for that 2 cuts for the year for the first couple months, and then start drift towards neutral. And then, we spent the last couple months thinking that there was going to be hikes. I think that graph, of course, is then very indicative of like the bond returns as well.
Sure.
As we've drifted from not having cuts to hikes, the bond performance has suffered. Yeah.
Well, I think so. LPL says in their thing that returns should be for bondholders, that you should be looking at returns should be income driven, not price appreciation driven. So coupon clipping is the operative phrase here, and that sounds about right, don't you think?
Yeah, it would be my hope that for the second half of the year that we saw the bonds decline in value over the first half of the year. They probably have priced hopefully have priced in the hikes. Therefore, they can stay pretty stable in the second half when we pick up interest, right? I mean, that's probably at 4.5%, interest on the ag.
Yep. Well,
I still think it makes more sense because they're calling about what short-term and inflation protection.
Yep, short-term maturity bonds and TIPS, Treasury inflation protected securities.
I don't know if that's
they're calling the sweet spot.
What I would agree is the sweet spot. I think intermediate could make more sense. I mean, if things are stable, you're getting paid more,
right?
And, if things do weaken a little bit, we don't get hikes, then you're going to get more appreciation on the bonds, maybe. But that's what my dartboard told me this morning.
That's what your dartboard says. Well, they're saying that they think that the Treasury yield curve is going to stay fairly flat.
It's not that flat right now, I don't think.
Yeah, it feels like kind of a normal curve, doesn't it?
Yeah.
Well, if they think it's going to stay as is, maybe let's put it that way, then yeah, I think intermediate term bonds or this, this is where a good bond fund manager can really come in if they got to go anywhere kind of bond fund that lets them kind of make adjustments versus at the portfolio level trying to stick it in style boxes or asset classes, right? Because if things are going to be if you need to be nimble with what's going on with the yield, the 10-year or the yield curve, let the bond fund manager do it for you. I would think.
Yeah, definitely. Because I think down the road you will see at some point, and who knows when, rate cuts happen, the intermediates are going to be a better beneficiary of that than the short term. So,
Yep.
But making these calls, and if you're really overly active, I don't want to be overly active on bonds, trying to make a call in the short, and then knowing that I have to eventually move back out to the intermediate. Like you said, if you have that nimble bond fund manager do that, I think that's a good piece to have in the portfolio.
I think the lower risk is obviously with the shorter side, but
Sure.
I think you get a higher expected return in this environment with a more intermediate.
Well, it's tough if you're someone with a really bond heavy, like you're risk adverse, maybe you're older, taking income from your portfolio, you are looking for, you have a bond heavy portfolio, but these yields are really low, and then you've got really short bonds in there. I mean, your portfolio is not really it's not doing much for you, right?
Yeah.
Right.
I mean, the difference between that and money market, you're talking a percent or two annualized. Like,
yeah, it's not a lot.
Worth the risk. I don't know. I just don't. If you're a conservative investor right now, you're in a real jam, because you don't want to go out and get part of you don't want to jump in the AI hype. Yields are not moving down, so you can't get price appreciation out of your fixed income, but it's not like interest rates are high enough for you to, like LPL saying, clip the coupon and work on the income there. So you're in a jam right now if you're conservative, right?
Yeah. Well,
or at least that's my take.
Going forward, the good thing about interest rates going up is that you're getting paid a higher yield. I mean, I think that there's some good bond funds out there, hovering around that 5% interest rate right now, which again, most people are going to be very happy with.
Yep. Yeah, I don't know. It's going to be interesting to see what I think rates are really going to drive what people are doing here, because there's a lot of cash on the sidelines right now as well. I mean,
yeah, you're getting paid to wait right now.
Yeah, but you were getting paid 4.25 to wait. Now you're getting paid 3.5. If maybe LPL is right, and we do get a rate cut this year. Now we're starting to look at money market yielding 3 or something. Let's say, is that enough to put that money on that dry powder to work? I don't know. I don't know what it's going to take. Maybe a 2 handle on those. All right, let's keep rolling. So we did the economy, we did stocks, we took a look at the bonds and what they're saying. And then they have some themes in here. I think we're kind of at the end here, but these are alternatives, commodities, currencies. We're not doing that. So what they really start this with is they're talking about other things that are going on, midterm elections, AI investment, that kind of stuff, moving from AI hype to proof and how that change is going to go on. They said the big tech, let's see if I can get to the AI part here. Not that we really want to talk about the midterm election, but we can touch on it. AI is moving. They're on track to spend more than $750 billion building AI infrastructure this year alone. But the market's now starting to ask the harder question: is this all going to actually pay off? LPL thinks that the AI theme is going to survive that transition, but it's going to become more selective. Companies that can show real earnings from the AI investments are going to be rewarded. Those that can't will likely face pressure, and that means broader diversification across sectors, not just a concentrated bet on technology, is increasingly important. I've said all along, it's really hard to know who the winners and losers of all of this is going to be. I mean, you go back to the tech bubble, and you're talking AOL and Netscape, and the ultimate winner of the internet, which is arguably Google, didn't even come until they were rising from the ashes of the tech bubble burst the first go around. So, Anthropic and OpenAI may not even exist 10 years from now.
Well, the proof's not going to come all at the same time. We're not going to know who's winning and who's losing on the 17th of the month.
Right.
It's gonna it's the timing is the risk, right?
Yeah.
You pull the plug too early on something, or punish a company too soon, or wait too long to say, hey, these guys blew it. I think that's kind of where the risk is in the time.
Well, I also think that everyone has done well generally. If you're in the sector of AI, has over the years has done well, and as we know, probably that can't. Again, they've just been lifted by being associated with it. But I think there comes a point where you actually materially have to have done something right and there's going to be some that did not and overspent, and they will get punished eventually. Like this shows right here all the spending that's happening, and we could talk about how this spending has probably helped the economy significantly. And the question then becomes too, when does this eventually slow down? This money stops trickling, through the economy.
Yeah, and there's no answer for that. I think like the DeepSeek scare that we had, was it now 2 years ago, with the Chinese model that came out that did 95% of the quality of the work for about 5% of the cost. I mean, I'm slinging numbers around here, but it was something very cheap, where you weren't getting all the way on those frontier models, but you were close enough. It just makes me think that there's a very real possibility that AI, in the way that most people use it, gets commoditized even.
Sure.
And then you're like, okay, there's some research departments that need these frontier models, but most people and most businesses day to day can get by just fine with a locally hosted large language model, and you're off and rolling for not much cost. I don't know if that's where the bubble bursts necessarily, but I just don't think it's a slam dunk in the way that people are investing in it right now.
I don't think it is, but it's, the crazy thing to me is that you're looking at these companies, and just by name association, you kind of just think of these companies as like the smartest companies around. Again, up here, Microsoft, Amazon, Meta, Google, and you're like, these are smart companies, and yet they're all doing the same. They're all doing the same thing, which is spending a ton of money.
Yep.
So in some ways, you got to think, what do they think is going to be the end game, and that they're okay spending all that money, versus us sitting on the sidelines, kind of questioning what they're going to be able to do.
Yeah. This is not pets.com, where you have a company that doesn't make any money, like Google and Meta, like print money. They just happen to incinerate it on AI stuff, versus companies in the late 90s that didn't make a nickel and never were going to. So there's certainly some differences between the internet bubble and whatever it is that's going on now, but there's some similarities too, I think.
Yeah.
Eric, do you ever get anybody saying, oh, well, why, whatever, this ticker is up 40 something %, or my neighbor's up 50% on AI stocks, why aren't I up 50%? Do you get any of that yet?
Not so much. I think people they've seen the hype before. But yeah, there's definitely, a fear of missing out on some of this stuff. But, to this article's point, there is kind of a turning of the phase. Like, it's not just, what's your AI strategy, to like, hey, show me what this AI spend is doing.
Right.
So,
yeah,
seeing some of, revenue or productivity gains or anything is going to drive the next, I think, wave of AI.
Yeah, and it's not just on our personal level, where like it's a more powerful Google search for like the three of us and other people, right? We're talking about businesses installing this and doing more with less and fewer people and that kind of stuff, and
reducing costs overall.
Well, yeah, I don't remember. Was it GitHub or somebody that had blown through their entire AI budget here halfway through the year?
So I had heard a podcast, and they talked about that. I think that somebody spent like $250 million like in a month, because they had no guardrails on it.
Yeah.
And it was the token usage.
Who is this company? Who is this? I heard on a podcast this weekend it was Uber.
Oh, it could have been. Uber, I think there are a few of them.
It was Uber, Tesla, and another one, like, because they're just the team's telling them, hey, use this AI, get it done, and it's pay per token or whatever. And they just blow through these budgets.
They blow through the budgets. Well, and I think it was Chamath on maybe it was in the All In podcast, was saying, they had spent all this money and they had gotten to like a 5% increase in productivity or something like that. And so I don't, it's not like anybody's waking up and saying the emperor has no clothes right now with AI, but like the rubber is actually starting to hit the road. They're saying, okay, what are we getting from this spend? Maybe we need to pull it back. But there, on the other side, there's this arms race, because it's like Alphabet,
can't be left behind.
Amazon, they're all treating it like it's a winner take all, and there's this arms race that's going on. I guess that benefits us, but you got to watch it on the other end, I suppose. I don't know. I get asked often if we use AI as part of our investment process. And the answer so far is no. It's not that we don't use AI around here, like many other offices do, just not necessarily in our investment selection process.
Right. I get asked whether or not we use it in the office. I haven't gotten asked whether it's part of how we choose investments.
Yeah, I mean, the answer right now is mostly like proofreading newsletters and things like that. But that's like kindergarten level AI usage, I think, right now. compared to what some others.
Well, here's a good question. How many subscriptions do you guys have for AI right now?
I'm embarrassed to answer that question, Brian. I think I have all of them.
You have all of them?
I think I have all of them.
So I have.
Wait. We'll give a number for all of them.
4.
Okay.
I have 4 subscriptions, but one was a year's subscription that I'm not using. Perplexity is the one that I'm allowing to expire.
Okay.
And I used Perplexity for a while because when I do queries, it would provide the sources.
Okay.
And it was one of the only ones that was doing that early on. It'd give you the references. Oh, well, you're talking about yields, and it's, there are links to where the Treasury Department stats were or stuff, but they all do that now. And so I'm letting Perplexity expire. I pay for the Google one, but that's only because it's part of the Google package.
Google One.
Google One. Yes, that's right.
Oh,
that's
Google
like
One.
saying, I pay for Amazon Music. Well, I don't.
Yeah.
Really. I just have Prime,
Right.
right?
Prime. Yeah.
So there's some throw-ins in some of those also. I don't know. It's interesting. And they all do different things better in different
They are
things.
all good at different things. Every time I think there's the catch-all, like I remember when Gemini got its great
really
update.
good to just run some of the same queries on multiple ones to see what comes up different.
Yeah. One thing that drove me crazy was ChatGPT never knew what day of the week it was. I mean, it might now, but if you said, okay, today's Monday the 13th, it wouldn't know that it's Monday.
Oh, Gronk gave me the future. We were on vacation in Idaho, and my wife was gronking to try to figure out where the fireworks were. And it was like, well, the fireworks were wonderful last night, and it described what the whole fireworks show.
Yep.
My wife was like, oh my God, we're in the future. I was like, it's July 4th. And I was like, oh, sorry about that.
Yeah. I know when you have to correct AI, it's like, oh, good catch. You're like, this is really elementary. This should not be a good catch. All right, fellas, which AI do you use most often?
I'm still using Claude a lot.
Yeah.
Gemini's free for me, so it's like, it's nice to use. I'm like ChatGPT, whenever I do something that's a little complex, so like put an attachment to it, it literally asks me to sign for a subscription. So I stopped using it because it's like it's no use to me unless it's really simple.
Oh yeah, you hit limit usages on ChatGPT pretty quickly.
Yeah, but I use ChatGPT probably now once a month, and it still does it to me.
Oh, really?
So I'm just done. I'm completely done with it.
When you pay,
it's not good with technicals. Like Claude is good if I needed to do something with a spreadsheet.
Yeah.
Or convert something. It can do a great job.
Yep.
ChatGPT does not know how to do that at all.
No. I would say, Eric, which one you use the most, Gronk?
I use Gronk the most on the day-to-day, but I think for work kind of stuff, I use Claude.
Yeah, I would say work Claude for me too. And then kind of personal stuff, I probably use ChatGPT, to bounce. It's like for ChatGPT, it's like bouncing ideas off of a buddy.
Yeah.
Not technical. Like, hey, what do you think about this? Kind of crowdsourcing type stuff versus because I figure it all comes from Reddit anyway.
It does remember too much though, because I asked it how to make like a pork schnitzel once, like months ago, and every time I ask it something, it somehow
relates it to it.
Yeah, it's like, oh, and if you're doing a pork schnitzel, that would be a great book to read. I'm like, stop with the schnitzel.
I've told
the
it
book about
before
bicycles
to stop. I've told it to stop before, to disregard that information so it doesn't keep using it. Because I've had the same thing on Claude.
Yeah. Well, they're all every time I turn around, they get fine tuned in another way, or there's a headline that they're releasing some sort of thinking model, and none of us code. As I imagine, not many of the people that are listening to this code either, and so it's going to be. It seems like these are coders building coding tools for coders, as opposed to, the focus being on everything else. But we'll see. I don't know. The application, the money making application for these, it really seems is for business, as opposed to individual users. ChatGPT isn't going to. They're not going to justify their valuations at $20 a month subscription to Joe Schmoes like all of us. All right, let's do a couple more of these. I'll just touch on a couple of midterm election. LPL's base case for midterm elections: split Congress, meaning more gridlock, more executive order driven policy, and historically more volatile markets in midterm years. It's a standard playbook. And you have to have a plan for buying dips once election year uncertainty clears. I don't know. It seems like the Senate's going to stay Republican and the Democrats might take House, but too early to tell, it would seem. I don't know. I think banking on some midterm volatility is probably a good thing to do.
Like elections, I think we've talked about this before. They don't really have huge impacts on markets medium term. I mean, unless there's spending stuff and energy policy, but the midterm election, I don't see a whole lot changing regardless of which way it goes, right?
Yeah, it's not like policy is racing through Congress right now, even with Republicans in control of both houses, right?
Yeah.
I think the midterm election is good for disruption in September and early October, as investors kind of step to the sidelines to wait to see how it all plays out. But I don't know if it's really an investable strategy, midterm elections.
No, because we all know that the day after elections, no one cares about it anymore. The markets don't care about it anymore.
Yeah, the question's been answered. You know who's going to get sworn in January, and then markets take November and December to rally higher. I mean, not every year. We got to preface it, but that certainly seems to be the cadence that we get. They also talk about resource nationalism. The number of active global export bans has gone from near zero in 2019 to over 350 in 2025. Governments are treating energy, materials, and critical minerals as national security assets, not just commodities. That's a structural multi-year tailwind for energy, materials, and commodity-linked equities that a lot of people don't think about in their portfolio theme. This does seem like a trend that is impactful and that has some staying power over the next handful of years.
Supporting prices, demand, it can, if the government creates demand, creates storage, it can support prices. I don't know how sustainable it is for everybody long term though, right? Because people do want to exchange this stuff.
Yeah. But it may be the free market, free trade kind of approach of the late 90s and 2000s is maybe in the rearview mirror at least for now. I don't know. And then we already talked about the Fed chair. The new Fed chair, Kevin Warsh, inherits sticky inflation and active global political shock simultaneously with no grace period. That's for sure. I think it's interesting. This could be in a whole different podcast itself, but the Walsh selection by the president, a president that is seemingly consumed with lower interest rates, has now picked a guy who, if he even lowers rates, he's going to do it concurrently with shrinking the Fed balance sheet, which is
kind of an offset,
less than stimulative. Yeah. Given what Trump has said, does he have someone in his ear telling him something different? Did he mistake? Yes, I'll cut rates as I shrink the balance sheet. As you just heard, cut rates. I don't know. What do you guys think about the new Fed chair?
I don't have much to say about him. You got to grade him as he goes. I mean, yes, it's a contradiction to what you would have thought Trump would have wanted, what he's been barking for all this time. But in terms of what this guy, he wants to use current data. I'm not opposed. I'm not opposed to that. Like having a little bit different philosophy than previous Fed chairmen, not always having to spell out what you're going to do over the next 6 to 12 months, because I do think that it sounds great to be able to for us to know and hear what they're going to do. They really want to do over the next 6 to 12 months. I do think it puts them on the hook to stick to that. And the world, as we know, it's hard to predict what 6 months or 12 months is going to look like. So I like some of the ideas he has.
Yeah, I mean, he came out and said he wants to be done with forward guidance. And the minute he said that, almost every other central bank around the world said, whew, yes, we want to be done with that too. At least someone said it finally. He took the reins and did it.
Yeah.
I think a lot of people would say shrinking the balance sheet from $6 trillion is something that badly needs to go on. But he's saying he's going to do it no matter what. It feels like a Paul Volcker moment, which sounds good because history looks fondly at what Paul Volcker did for inflation. But
that was a tough ride.
The two recessions that came back to back over the course of that. So it all sounds good in theory. In practice, it might be a little bit painful for everybody.
I'm all about change, mixing. It's been a while, and he's not like a monetary policy king. There's a whole board of people there. They have to vote to do stuff.
Sure. So, 7 out of 12 people need to vote, but it seems like there are a lot of things. A lot of big things got done in 2008. that we've just kept doing now for nearly 20 years.
Yeah, we should take a look at that stuff, right? So
yeah, we like maybe emergency actions don't need to go on when we don't have an emergency. And I think that's maybe the gist of a lot of this stuff, where a lot of that forward guidance and a lot of the balance sheet expansion all came as a result from the Great Recession.
Right.
Okay. Well, I think we can leave it there. I think we could probably summarize by saying LPL's outlook is murky, as is ours. So all we can do is kind of take it as it comes. Anything we missed in the mid-year outlook that you wanted to touch on that we're allowed to touch on from a compliance perspective?
No, but I'll say this. If we get to the higher end of LPL's expectations for the stock market, let's just say that's 3%, add that on top of where we are already today. We're sitting at 12+% returns for the S&P 500 for 2026. We can't complain about that.
No. But just keep in mind, as we record this, I'm just rounding this off. The S&P's up 10% on the year. If we hit, okay, here's a question for you both. If we do get up to 12 or 13% on the year, which means we're up 3% from where we are today, is it going to be in a straight line slowly over 6 months, or is it going to be a hell of a ride just to earn 3%?
I think we get there and then it gets bumpy.
Oh, we get there like into summer and then it's a rocky ride, but kind of cut sideways until the end of the year, Eric?
I think so, just because of the midterm noise that we were kind of talking about before.
Yeah.
But I want to caveat that with saying that we have an inflation report tomorrow and GDP at the end of the month.
Yep.
So those two numbers could change the outlook.
Oh, it could change everything in a heartbeat. I for one, think it's going to be a lot of 2 steps forward, 1 step back. Like we could easily get up to 15% year to date and then come back down to 12 and then get up to 15 or 16 again and then come back down to 14 or some, a lot of the up and down, back and forth. Okay. Well, we always close out these by asking, what's the question? What's on your mind? What have you been reading, writing, listening to? How have you guys been killing your summer travel time? You listening to books, podcasts, reading stuff, watching a show? What are you doing?
I guess I'll go. I mean, I have a whole lot of nothing. I feel like, to be honest with you, this is the year where we're taking probably the least amount of travel. So I don't even have like a real travel story to go on this year. But the nice thing about summer for me is it's like the low key element of not having kids activities, after work where you run into. I usually in the morning go to the gym and then take a shower and come right to work, where usually during the school year, I do that, but then I have to wait around until school starts and then I have to take the kids to school. So it's just, for me, it's like a real easy kind of laid back period of time where, I'm not a lot is asked of me at home right now to do things. And so it just feels like a less stressful time of the year, even though I don't get summer break like the rest of my family does.
No, I was going to say, it sounds like, Ryan, you have some bandwidth. Maybe they can help me out with some stuff.
Yeah.
I don't do anything remodeling, if that's what you're asking.
I know that's what you've got going on. Yeah, Eric, are you swinging a sledgehammer so there's no reading or listening or watching anything?
Spending every chance I get getting out of town, just for the weekend if possible, because our house has got some stuff going on there.
Well, if you're not home, then you don't have to work on the house.
When I am home, though, I do have a sledgehammer and I wreck stuff I'm allowed to.
Do you have a kitchen?
It's a kitchen / living room / my bedroom.
Oh, so, okay.
Just
like
good.
Hot plate situation.
Yeah.
I kind of like you guys, or like you, Ryan, I basically wake up and hit the gym and don't really have much of a commute, and have done some traveling, but not so much that I could really like consume stuff. I definitely am not watching anything other than sports. I've watched a obscene amount of Wimbledon here in the last 2 weeks. I did, on a client's recommendation, I read a book called Finding Ultra. So you probably know Rich Roll as a podcasting bro dude, but he did a bunch of Ironmen. What's multiple Ironman? Ironmans?
Ironman?
I don't know. He did like 5 in 5 days in Hawaii, and that was his like claim to fame. And so the book's called Finding Ultra, and it was cool. I don't know if it's a recommendation, but it's about him kind of like figuring things out and getting down to kind of his personal challenges he wanted to get through. But he did it as a vegan, which really doesn't appeal to me, but whatever. So that's the last thing that I've read, and it was okay.
Is an Iron Man going to be your resolution next year?
No, God,
Iron Man, Mans.
No, not even one. No, I don't even. I mean, I might run a 10K max. That's it. I don't want to do a half marathon. I'm going to leave the marathons to Ryan's wife. Like, I'm not. No, I'm not doing that stuff. Not at all. I don't know. I've got 6 months to figure out what my New Year's resolution is, but it won't be an Ironman. I can tell you that much for sure.
I think our New Year's resolution is just to have our body survive the year.
No more
like detours on health, issues with backs and arms and knees and all that stuff. I think that's going to be my 2027.
Yeah, I've spent most of this year not being able to raise my left elbow over my shoulder. So yeah, just getting healthy would be a good enough resolution for me. So, all right, fellas, we'll leave it there. Maybe we'll do one of these again more than 6 months from now. That would be great. But
that'd be a good thing.
Yeah, I think so too. All right, we'll leave it there and we'll jump into the next one. If you have questions, if you've listened 45 minutes into this and you have questions, you can email us at info@fordfg.com. You can subscribe on Spotify, Apple Podcasts, YouTube, wherever you listen to your stuff. Eric, how do you listen to podcasts?
I ask Gronk.
Oh, really? And it plays through there?
In my car, yeah. It finds it wherever it's hooked up to the car. It's hooked up to my phone. I don't know how it works.
And Ryan, you're still using some obscure player?
I use Apple mostly now, just because it's on the car, and so it's just a little easier.
See, I switched from Apple to Spotify.
Okay.
But that's because it's on the car. Rivian doesn't have Apple Podcasts on the car.
Got it.
So we're just all listening through our cars?
I guess.
That is telling, right? For about friction and how we're all switching who's doing how you're listening just based on what's convenient. Interesting. Yeah. It's commoditized. All right, guys, we'll leave it there. Until the next one, good luck.